All of what I've said so far has been about macroeconomics, and of course what's going on in the background is markets are saying, well, you guys, in the central banks, get on with it, you economists do your forecasts. Meanwhile, we're up 30% last year. S&P 500 was up 30. So another risk is that it doesn't actually, that the disruption, if ever it happens, does not come from the macroeconomy or policy. It actually comes because the market's in a bubble. Therefore, we've been trying to measure the probability of a bubble, which may sound a little bit self-contradictory, but there are new methods of doing this. It doesn't appear from price action at the moment that the S&P is in a bubble. And what I'm showing here is actually the degree of support means probability. The probability that the S&P is in a bubble going back to 1900 and running through to the present. Interestingly, at the moment we're at the low end of this. Now you might think this is a little peculiar, right? I mean, the market's just been up 30. The Sharpe ratio of the market last year was the second best Sharpe ratio for 30 years in the US stock market. So how can he be telling me that there's such a low probability of a bubble? Well, the answer is that for the most part, the growth in stock prices has been supported by either dividends or earnings. Not entirely recently, okay? But for the most part, you've had that. So when you adjust for fundamentals, which you need to do in these models, and you ask whether the price relative to earnings or dividends is showing explosive behavior, which is what you get in bubbles, the model comes back with a very helpful comment, no, we're not in a bubble. But if I thought we were in a bubble, I'd have a very different view of how to hedge risk positions and how long to hold them and where to hold them, because the chances of a much more rapid implosion of the bubble, and with very painful consequences that we all remember from that, would be higher.